how to make money when share prices are falling. Yes, you heard that right. Most of the time when you hear about investing, you hear about buying and then having the share price go up and that being the only way that you can make money. That is completely incorrect. You can make money from both prices going up and from prices actually going down. And that's exactly what I'll be showing you in today's video. And you guys know the drill. To show you all of this, I'm going to share with you what's on my computer screen. So let's go. So usually when we think of investing, we are usually thinking of share prices going up. So when you buy shares on a platform like Easy Equities, you would want the share price to go up from the price you bought it for. So if I buy ABSA shares right now at 148 rands per share, I want this share price to go up in value, because the way I'll make money will be for me to sell this share at a higher price than what I paid for it. So I'd want it to maybe go up to 160, 190, 200, 300 rands per share. That way I can sell it. But that's not always what happens. Why? Because the ideal scenario or the positive situation for a company or an economy doesn't always play out. Sometimes there's the middle scenario where things just go flat, and then sometimes there's the worst case scenario where a company just doesn't perform very well, when the economy just becomes really horrible. In that case, you can expect share prices to in fact actually come down. We saw this in 2020. When the pandemic happened, what happened? Share prices fell because investors and traders got pessimistic. They started selling their shares. They increased the supply of the shares, and those who were selling were willing to sell at lower and lower prices, and those who were buying were only willing to buy at lower and lower prices, and so share prices fell. And then when sentiment suddenly turned positive, what happened? Prices started bouncing back up as people were willing to buy shares, and of course those who had the shares wanted to sell them at higher and higher prices, and that pushed the share price up. But what I'm basically highlighting here is this: share prices have at least three realities: the share price going up and the share price going sideways, meaning it just goes flat, or the share price going down. You can make money from all three of these scenarios, and then in this particular video we're going to focus on this one, when the share price goes down. Because if you can predict that the share price can go up, that means you can look at scenarios where potentially the share price can go down and then actually make a return from that, either as a way of managing risk in your portfolio or as just a way for you to actually make an actual trade by short selling. So let's start here. What is short selling and how does it exactly work? I'll be really brief here on this particular section, but basically short selling is when you make the prediction that the share price is going to go down, and the way you would express that prediction is you basically borrow shares from another investor. And now this process of borrowing shares is actually very instantaneous, so you don't have to go look for someone to actually borrow shares from. You just press a button, and I will show you shortly when I give an example. So let's say we got two players here. We got Lebo and we have Bonga. So Lebo just bought shares of a company called Yummy Foods. She bought 100 shares, and Bonga believes that Yummy Foods share price is going to go down over the next 3 months. Lebo, on the other hand, wants to actually hold these shares for the next 5 years. So what does Bonga do? He borrows the shares from Lebo, and since the price of the share right now is 1 rand, Bonga then has 100 shares worth 100 rand from Lebo. Now, Lebo's prediction, on the other hand, is that the share price in the next 5 years is going to go up to 2 rands per share. But she's very much aware that during that process, what is most likely going to happen is the share price is going to go up and down. So in the next 5 years, she knows that the share price will be up to 2 rands, but during that process, the price is going to be going up and down. This is where Bonga comes in. He believes a scenario like this can potentially happen, where in the short term, the share price will go down before it actually bounces back up. And so he wants to take advantage of that situation. So what does he do? He borrows 100 shares, and each share costs 1 rand. And then he turns around and actually sells those shares in the market, thus gaining himself 100 rands. And then with that 100 rands, he just sits on it and waits for the share price to come down. Then when the share price comes down, what does he do? He then actually buys back those same shares that he sold, now for lower price. And let's say the share price went down by 20%, meaning the share price went from a price of 1 rand each to now a price of 80 cents, meaning to buy 100 shares, he has to spend 80 rands. And you can see already how the money is actually made. When he got the shares, he sold them for 1 rand per share, thus he had 100 rand. And now that he's buying them back at 80 rands for all 100 shares. And then what does he do? He returns the shares back to Lebo, and then he's left with 20 rands. Of course, there were costs involved in this. He'd have to pay Level some interest. Maybe he pays Level 3 rands interest on the whole entire return. So he's then left with maybe 17 rands as his actual profit. And that's how short selling basically works. Now, there's different ways of expressing this. So in most cases, you're not actually going to be directly short selling unless you're using an advanced broker like IBKR. In most cases, you're going to be using what we call a CFD contract, where basically you buy a contract that tracks the price of a particular share. So let's just quickly look at how short selling would work. Let's say I wanted to short ABSA. Now, normally what I do is I would press buy, because I believe the price is going to go up. And we call this a long position. But in this case, let's say I believe the price is going to go down. So what I'm going to do, I'm actually going to sell. So I press sell market, and then the transaction, in fact, actually goes through. But let's go look at it more closely. So I've opened up a detailed trade box here. I opened a paper trading account on TradingView, and I will show you how this is done on a few brokers. But just to give a quick example, say I believe the share price is going to go down. I believe ABSA is actually going to have a bad time in the economy in South Africa for the next couple of years, and I can see the price right now is 148 rands. I want to make this a market order, meaning I want it to be instantaneous. I'm going to short 10 shares to the value of $79, and I'll set my take profit. And notice my take profit now is not above the share price, but it's below the share price, because I'm predicting that the share price is going to go down. And my stop loss is going to be actually above the share price, because obviously I'd be losing money if the price in fact actually went up. So what do? I then press sell, and then the transaction goes through, and just like that, I've opened a sell order where basically if the price does go down, I will actually then make a return. I can in fact actually open up the calculator here and calculate potentially what would happen if the price went down all the way until July 2027 and it went down by 28%. I would in fact actually make a return of 28% from that move. So which brokers can you actually do this with? There's a few that I do like. One of them is IG Markets. So this is one if you can afford to deposit the minimum deposit amount. I think for IG Markets about 5,000 Rand. Then you can go ahead and actually start shorting some shares. So you can see I've already opened a few shorts here. I've got one of Anglo American, and it's currently making 8 Rands 20. And then I've got another short here of Impala Platinum, and it's currently losing 2 Rands because the price has gone up, while with Anglo the price has gone down, and that's why I'm making money. So we can actually go look for a couple of other shares, and then we can actually short them. The question is obviously, how do you do the analysis on all of this in terms of figuring out which shares to actually short? I'm not going to get into that for this particular video, but one of the key things that you have to look for is obviously a negative economic environment. That's always something that will definitely help you as an investor. You also then have to look for weakness in the company's financials, especially when it comes to earnings and various other things that investors expect the company to do very well in. If they fail to do that, share prices tend to fall when investors actually sell their shares, and then obviously you can take advantage of that drop in price. So I've got a system here called Opportunity Spy. If you want me to share it with you, then you have to join my investing mentorship program, but it's one of the tools that I utilize to actually find what shares to actually short and also what shares to actually buy. Then another broker that you can use is GT247, which is a sister company to Easy Equities. So you can open up an account with them and then download their platform and then actually start shorting shares using CFD contracts, which is a contract that tracks the price. And then another broker that you can use is Brockstock. You can also use them. They also offer CFDs. We can basically track the price of a particular stock. So you then enter sell order, and then if the price falls and you exit the trade, you will actually make a return. And so that's how short selling works. There's a lot of ways to use short selling. One of the ways that it tends to get used is obviously as a tool to manage risk on positions that you've already bought. So if you buy shares for, let's say, the next, so you buy shares today, you expect them to go up in value over the next 7 years, but you know during those 7 years there's going to be 2 years of down time. What you can actually do just to hedge the risk is actually short sell that particular share. So while the share price is going down, you in fact are making a return, balancing out any losses in your main investment position. If you want to learn more about that, then definitely sign up for my investing mentorship program. Thank you guys for joining this video. I hope you enjoyed it. If you're interested in any of my programs, then click the link in my bio to join any one of my programs, such as my Easy Equities Investing course, or you can subscribe to my channel for even more intense information. Until then, guys, enjoy the rest of your day. Goodbye.